and then I would have purchased the last 4. So my ending inventory is actually 28, 34, 38 for my ending inventory, and I'm just adding up the dollar value on each of these. My cost of goods sold is 57. I add up all the items that I sold. My gross margin is 53, 110 minus 57. So those two are pretty straightforward, and that is perpetual. What if it's periodic? Well, if it's periodic, then the dates that I sell it don't matter. I'm not keeping track of that, because perpetual means ongoing. Periodically, when I'm using periodic, I go in and I count to see how much inventory I have left. So if I'm doing a periodic, let's just look real quick at how that works. Periodic is actually easier than perpetual, but let's take a quick view. So I have all of these items at the end of the month. They're just all were purchased during the month. And I need to determine what's my ending inventory under FIFO if I'm using periodic. Well, I sold 11, first in, first out. Which ones did I sell? I would have sold all the blue ones, the yellow ones, these over here, and 3 of the green ones. And then again, we could just add up these items here. I'm just looking for my draw. Anyway, all of these items as my cost of goods sold, and these would be my ending inventory. If I'm doing LIFO, I would sell the 7 red ones, or the 4 red ones, the 6 green ones, and 1 of the yellow ones would be my cost of goods sold, and my ending inventory would be the 3 blues and the 4 red. Okay. Let's look at average cost. It doesn't really do me any good to move the balls around here to do the average cost. So how does average cost work? Average cost means I have to determine how much each unit is on average each time after I do a sale or before I do a sale. So in order to do that, I am going to look at my cost for each item when I get ready to sell it. So when I get ready to sell these 6, I have to determine what is the average cost for the 3 blue plus the 5 red, or I can't even talk tonight, the 5 yellow. So 3 times 2 is 6, 5 times 5 is 25. Again, that's where these numbers are coming from. I add those numbers together and divide them by 8 to get the average cost. And I take that average cost times the 6 that I sold. Let's see if I can prove that number to you here. Oh, I guess I have it here. So this is where I was showing that work up here. I sold 6 at $387 for $23.25 average. That left me at 2 at $3.87. And then we bought 6 more, which were the green at $6. So we had 6 at $6 for $36 to give me a new total cost of $43.75. Divide that by 8 again to get the new average cost. The new average cost is $546, and then we purchased 5. So that was my $545 or my $546 here for my cost of goods sold to get my $54, and that equals our $44.40. If I'm doing average cost just periodic, then I just add up all of my costs, divide it by my total of 18. In this case, I had 5.27 or 5.28, and then I would just say, well, I sold 11, so it's 11 times 5.28. That's my cost of goods sold. And my ending inventory would be the 7 times 5.28, and that gives me my ending inventory. So average periodic is easy, whereas average perpetual is the most difficult method. I know in my accounting lab they ask you to do these methods. Did anyone have a specific question where you were trying to do this homework? If so, you can just type it in the box and I can answer that. Okay. Now someone said I could hear your kids in the background. Sure, I could hear the kids, and that's fine. I don't usually have the mics open when I'm doing a webinar because I am recording these so that I can post them. Any questions so far on inventory or any specific questions on inventory? I don't seem to have a textbook in here. So let me get to my accounting lab and pull me up a textbook. Now my internet's going out. Hang on. Totally unprepared. Okay. All right, I think I saved my internet. No questions. Okay. If you think of specific questions or if you've looked at your homework for this chapter and you want me to look at something specific tonight, I will. I don't usually do that, but tonight I will look at something specific for you. And I'm going to just pull up my accounting lab so I can get a textbook. It's different assignments, I think, than you use, but just a second. Okay, so while I'm pulling up a textbook, Chapter 7, and actually, because I have been gone, I didn't lecture for Chapter 7, so hang on just a sec. So I hope that each of you are reading your chapters. I hope you're all doing all right in the class. I know students tend to struggle with this course in particular online, and I wish I had easy answers with you. What I was actually doing in Afghanistan was working on curriculum development with some students or with a college that's a two-year college over there, and the instructors, who are mostly Pakistan and Indian instructors, were telling me that there was no way that they could teach the amount of information to their students in one class as I was telling them they would need to in this class. And I tell them I do understand, because our students struggle with it as well, but it's a necessary evil that we get this done and in a chapter if you're going to be accredited. Okay, Chapter 7 is plant assets, natural resources, and intangibles. So now that I know what the chapter is, let me pull up one other item here. And we'll use the PowerPoints as talking points as soon as I can get them pulled up. Has anyone worked on their homework for Chapter 7 with depreciation? And did it work out pretty good for you, Bridget? Or did you have specific questions about that? Good. Depreciation is one of my favorite topics. I like inventory really well too, so you just hit me on a couple of the chapters that I really like to talk about. Okay, I'm trying to pull the PowerPoint. But with depreciation, it becomes very, very real when you are a business owner. I'm somebody who gets so caught up in my job that I sometimes don't always do the planning that I should do, and we do farm as well as me working at Ivy Tech. And so I ended up paying a boatload of taxes this year because I should have purchased something so that I could have used depreciation as a business expense and not paid the IRS all that money. But at any rate, depreciation can really help you manage your tax liability if you are owning your own business that has assets that have a long-lived life of longer than a year at least, so that you can take advantage of the tax breaks related to that. So I guess what I'm saying is do as I say, not as I do when you get your own business and have fixed assets. Okay, can somebody tell me some type of business assets you might own that you would depreciate? Can you type in some types of assets a business could use as a depreciable asset? My PowerPoint's loading. Vehicle, building. Yep. Those are both two things you could depreciate. How about a computer? Could you depreciate a computer system? Yeah. What about a mailing list? If you had purchased a mailing list from another company, could you depreciate that? Okay, a mailing list you would actually amortize. A mailing list is an intangible. I kind of walked you right into that to trip you up a little bit. But intangible assets such as goodwill, patents, copyrights, mailing lists fall under that category. Those types of things you amortize, which you take a look at it. Yeah, it's like a patent. Or you treat it like a patent. You take a look at it and you determine if it still has value and if you need to write that down with your amortization. Amortization has changed in my professional life. Everything used to have a set life. Goodwill would be 40, a patent would be 17, I believe. Copyrights had a longer life, and you would straight line depreciate or amortize over those periods of time, and that has since changed. But it's nice to put some thought to that. This chapter talks a little bit about the intangible assets of which we amortize, and it also talks about natural resources of which we deplete. So there's a depletion expense instead of depreciation expense, and that would be for oil or maybe coal you were taking out of the ground. It can be for if you buy, say, a forest or a woods and you're using the trees for lumber, you're logging, then that can also be a depletion of the asset, but you still have the land that it's sitting on. So let's talk a little bit. We'll go right through the Chapter 7 then, and I'll try to take a few specific questions if you have it. If you think it's something with Chapter 6 as well, then I'll look at those. And know that you can always, you should always be able to use the Ask My Instructor button from my accounting lab, and your instructor should respond to that. You should also be able to use either messages or email for your instructors, and there's also the discussion boards to ask questions about each chapter in your class. So never hesitate to ask questions. You just, one of you said that you were try to work a week ahead, and that's great because that allows you time to ask questions and get help. And if you're working right at the deadline, that's hard to do. So keep that in mind as you're working through this. So we're going to talk about long-lived assets. These are assets with a life longer than 1 year. If it has a life less than 1 year, you would just expense it. And I would tell you that every business, there's, and how much you use something that might be a long-lived asset for one business would be an expense for another business. I'm trying to think of examples of maybe a nailing gun. Maybe if you're in construction and you do a lot of work with the nailing gun, then you may wear that gun out annually, and therefore it's just an expense. But if you're someone who has purchased that, let's say we purchase one to work on the farm buildings with, we're not going to be out there day after day using that, so it might last us 5 years. So it would depend on what that piece of equipment's life is going to have, how you would decide whether it's a depreciable asset versus an expense. Another thing to think about that the book doesn't really go into, but in case you end up out there with your own business at some point in time or working for a small business, is that every company should have a policy of where they have the threshold of what they expense versus what they depreciate. I probably am never going to depreciate anything that doesn't cost at least over $500. If it's less than that amount of money, I would just expense it because by the time it just isn't logical to go to the work. There's no cost benefit to go to the work of depreciating it, but it's a policy, I would treat everything that same way. I wouldn't depreciate some things that were less than that, not everything that was less than that. So keep that in mind, that a term that you may hear in accounting is threshold for reporting something. So we kind of talked about this already. I didn't specifically say that land doesn't depreciate, but land does not get depreciated on your financial records. I will say in Accounting 101, land doesn't get devalued. There are methods in more advanced accounting classes for land who has lost value that you can change its value on your balance sheet, but it is not depreciation. It's more the restatement of the value of that land. We would depreciate buildings, machinery, equipment, furniture and fixtures, and any land improvements. Those land improvements would include if we put a fence up or if we did lighting or paved a parking lot, those types of improvements. Depletion expense, we're expensing that through the cost of goods sold. And then intangibles are amortization expense. We talked about that already too. The cost of any asset is the cost of all of those costs incurred to bring that asset up to its intended use. That would include the purchase price, taxes, commissions, anything else paid to get that asset ready to work. If we had to pay insurance during shipping to get it to us, if we had to pour a cement pad to attach that piece of equipment to because we couldn't run it without that cement pad and without it being bolted down, then the cost of that pad would be part of its installation cost and therefore part of its actual depreciable cost. This slide just talks a little bit about the cost of land. It's everything, the brokerage fees, the survey fees, the legal fees, the property taxes that the purchaser pays, any expenditures for grading and clearing and removing unwanted buildings. That's a little confusing sometimes to students, but you have to remember that when we are recording the cost of the asset, it is getting that asset ready for its intended purpose. In this case, if our intended purpose was to build a new building and there was an old building we had to tear down in the first place, then the cost of that old building is part of the land. So I'm going to just click through this illustration. So FedEx had signed a $300,000 note to purchase 20 acres of land. They paid $10,000 for real estate commission, $8,000 for back property tax, $5,000 for removal of an old building, and $1,000 survey fee, and $260 to pave the parking lot, all in cash. What is their cost of the land? Was everything except the $260,000, because that $260,000 is a land improvement. How do we record it? We record the $324,000, and we had to pay $24,000 in cash. The cost of constructing the building would be anything that it took to build that building, get it ready to go. The architectural fees, the building permits, contractors' charges, payments for the material, labor, overhead, and interest on money borrowed to finance construction. So when you see that interest on money borrowed to finance construction, this is where you are said you are capitalizing your interest. You capitalize your interest because any cost of interest during the construction phase is part of the building, and it is depreciated over the life of the building. Once the building is constructed and put into use, your interest is an operation expense. It's a period cost, and you take it off, you expense it off your income statement each month. Cost of purchasing a building includes the purchase price, commission, sales taxes, anything that we have to do to repair or renovate the building for its intended purpose. So if we buy an old building that we have to go in, maybe we bought an old factory space that we have to go in and build into offices, all of that cost of construction goes into the actual price that we record as the cost of the asset when we record it in our journal. And equipment, this is where I said like if you had to pour cement pad, the cost of any special platforms. Basically, if the equipment cannot be used, so if I purchased a generator that had to be bolted down to a cement pad before I could use it, but I just had it stored in a crate out in a building out back, I could not technically depreciate that because it is not in use. It would be an investment at that time because I had invested in something for future use. So land improvements, driveways, signs, fences, sprinkler systems, they should be depreciated. Leasehold improvements are improvements made to leased property. We would depreciate or amortize it over the lease term. So if I leased space for my business and I did the work for that, then I would depreciate that over the time I held the lease. A lump sum or a basket purchase, we bought several items at the same time. So we have to allocate their costs based on their market values. This is called the relative sales value method when we do this, and it's just a little unique calculations. This is one of the things that I tell my students. This isn't accounting that's tripping you up. This is math, because there's nothing accounting about it. It's just knowing how to do math. So if FedEx purchased a building and land, the building sits on 2 acres of land, and the combined purchase price of the land and building was $2,800,000. The appraisal indicated that the land's market value is $300,000 and that the building's market value is $2,700,000. Well, if we look at that, we can see that the market value is $3 million. I think I said called that thousand, but it was $2,700,000. So that would be $3 million. We only paid $2,800,000 for it. So how do we record that on the books? We can't record it at market value because we have to record assets at their historical cost, at what we paid for them. You should recall that from Chapter 1 with the historical cost. So we do that allocation by listing the actual market value of each item, divide it by the total market value, and we see that the land is 10% of the cost and the building was 90% of the cost. Take that times the $2,800,000 we actually paid to get the amount of money that we record for each item. Land is an asset. We have more land. Assets increase on the debit side. Building is an asset. We have more building. It's an increase in our building account. Again, assets increase on the debit side, and we spent cash. Once we spend the cash, which is an asset, we have reduced cash, which means it's a credit. And this is just a little illustration again of doing the same thing. How do we know the difference in a capital expenditure versus an immediate expenditure? A capital expenditure is something that is going to extend the life of an asset, or its capacity. It can do more work or it'll last longer. Again, capitalized means the cost is added to the asset account and not expensed immediately. Like I said, the interest. So if I have an extraordinary repair, such as a major engine overhaul, or we bought a new body for a used truck, then that would be a capital expenditure. Ordinary repairs, if I need tires for my car, if I need to change the oil, if my windshield cracked, or I even needed to paint that car, then that would be an ordinary repair of which I paid as an operating expense, not added to the cost of the asset. So depreciation, the process that allocates the plant's asset cost to expense over its life. It allocates that cost against the revenue the asset helped earn during that period so that we are adhering to the matching principle. Depreciation expense is reported on the income statement, and land is not depreciated, clearly. Depreciation, just to help you keep in mind, is not a process of valuation, and it does not mean that we're setting aside or putting money back to replace the asset as it wears out. The asset has basically already been paid for. The money has been spent, and we are just simply matching the cost of the use of that asset against the revenue that it is helping to earn in the same period. Again, the matching principle. We need to know the cost of the item, how long its estimated useful life is, and its estimated residual value, or how much it's going to be worth at the end of the time that it's useful to our company. These are, of course, the cost is a firm number. We know what we paid for it. Notice again that the estimated useful life, the length of service expected from using the asset. We can express that in years, units of output such as miles or hours or some other measure. Again, it is an estimate. It's our best guess at how long that asset's going to be useful in our business. We can modify that at any point in time. We can decide that, oh, this truck isn't going to last us 10 years after all. It's only going to last us 7 years, so we need to recalculate for the remaining amount of time. Or we might decide we thought this truck was going to be worth $10,000 when we were done with it, but it's not going to be worth anything. It's going to just be scrap, so maybe $500. And so we can rework our amount of depreciation expense using that new calculation. So it's just an estimate. It's never going to be perfect. So I keep saying residual value, but again, what it's going to be worth at the end of the time to scrap it, or if we are just going to use it up to a point in time and sell it. It doesn't mean you don't necessarily have to use an asset up. Maybe you know that you trade your delivery vans every 3 years. Well, they may still have quite a bit of value left at that 3 years. But if your intent is to use them up to that time, then that's how you should depreciate, just how much you expect to use the value you expect to use that, your best guess to that value. We will look at 3 methods. We'll look at straight line, units of production, and double declining. Straight line is the simplest. If we paid $100,000 for a truck and we plan to use that truck 10 years and it not be worth anything in the end, then that would be $10,000 per year, straight line depreciation. Units of productions, we would usually look at miles if we're looking at a vehicle, and how many miles would we drive that truck. Maybe we know we trade our trucks at 100,000 miles. Then we would depreciate it off to 100,000 miles and estimate its residual value at that point in time. Double declining balance, it's an accelerated method. With an accelerated method, you don't consider the residual value up front, or when you're doing your calculation, you just don't go below it as you are going through the years. see what this is. Okay, I already said straight line is the equal amount each year. So I said this, but depreciation is the cost minus residual divided by useful life in years for straight line. Okay, and every time you do the entry for depreciation, it will be depreciation expense as your debit because expenses increase on the debit side, and your accumulated depreciation will be your credit. Accumulated depreciation happens to be a contra asset account. Contra asset, the word contra means opposite. So if an asset normally increases on the debit side, a contra asset would be credited to increase, in which case that's what's going on here. If we look at this, they're showing us the rate. They're showing us the rate so that when we get to the double declining balance, we'll know twice the straight line rate. But the rate is 20% per year. Oh, I'm so sorry. My time zones, I'm really still jet lagged, and it's the middle of the night where I came from. So got the tired going on. Depreciation methods. An asset is used in operations and is depreciated. Accumulated depreciation increases, makes the book value of that asset go down. The book value is the asset itself. So if I have a truck and I have depreciated it 1 year for $10,000, my accumulated depreciation would be $10,000. So my book value would now be $90,000, $100,000 minus $10,000. So here we're going to look real quick at a sorting machine that costs $10,000 with a useful life of 5 years and a residual value of $2,000. It was purchased on January 1st. What is its straight line depreciation? $10,000 minus $2,000 divided by 5. Is $1,600 per year. Units production is a fixed amount of depreciation assigned to each unit or output. So we would calculate how much is depreciation per mile or per hour of use of the machine. In this case, we're going to look at a truck again, and we say that we have, we're going to use this truck for 100,000 units, which are miles. So we get 40 cents a mile. So if year 1 I drove it 10,000 miles, then it would be 10,000 times 40 cents. Once we have the unit rate. So here's an example though. In 2011, we drove the truck 20,000 miles at 40 cents per mile to get our yearly expense of $8,000. First year, our accumulated depreciation is $8,000, and our book value has dropped by $8,000. Year 2, we drove it 30,000 miles for $12,000. So as you can see, we just keep the rate per unit constant and multiply it times the number of miles we actually drove to get our depreciation. We brought in our depreciation schedule. Remember, our residual value was said to be $1,000. This will end up at $1,000. Just the journal entry real quick. Double declining writes off a larger amount of the assets near the start of its life. It is the most frequently used accelerated depreciation method. There are others. Computes annual depreciation by multiplying the asset declining book value at the beginning of the year by a constant percentage 2 times the straight line rate. So double declining balance is twice the straight line rate. If you recall the example we were looking at, it was 20%. How can you determine the rate if you haven't already done the straight line? you can take 1 divided by the useful years in life. The 1 stands for 100%. So if I have 100% divided by 10, that would be 10% times 2, or 20%, divided by 5. 1 divided by 5 is 20% times 2, or and I would use 50%. This example, again, was 5 years. 20% times 2, I think I just said 20% times 2 was 50, but 25 times 2 would be 50. 40%, we would use 40% in this problem. So in this, our rate stays constant. So we started with, notice this, we started with the whole 41,000. We did not start with 40,000 because we did not take the depreciation off. Remember earlier I said in accelerated methods, the residual value is not taken off up front, and this is an example of that. So we take 41,000 times 40% to get our 16,400. We subtract that to get our new book value. Year 2, we are taking 40% times the 24,600. Year 3, we're taking the 40% times the 14,760. And we have to be careful when we get down here to year 5 that we don't go below the $1,000. Or in this case, it looks like we took the whole yearly expense off to get to it. Yeah, that's what I was. We did not take 40% times this, 43. We just have to end up with the 1,000 residual value at the end of the 5-year life, and that's why we took the whole 4314. So remember that the final year will be a plug. Sometimes you run out, depending on the depreciation rate, you run out before you get to the end of year 5. So you have to not go below the residual value. This is an example of where we ran out before we got to the end of year 5. So when should we use straight line? We should use the method that best fits the asset. Straight line, if revenue is generated evenly over time, then that may be the best recognition principle. Units of production would be best for assets to wear out because of use. So this is something that might be machinery more. Some machines are meant to run by the hour or so many parts, and by the time they get to the end of the the parts, then you know that they're either going to need a major overhaul or a new machine. And double declining balance for assets that generate more revenue early in their useful life. One thing that you will notice that when you are comparing this over the 5-year life of this asset, it actually, yields the exact same depreciation expense over the 5 years, but you can see how it's spread differently. So again, you can see why if it's generating more revenue in year one that we may want to use the accelerated method in order to keep our net income down and maximize our tax benefits from that. Also keep in mind that tax depreciation for income tax purposes is different than book depreciation, and that's why if you're keeping the books for a company, you may have an account called deferred income tax payable because you are postponing paying that income tax. A little graphical if you're a visual learner. So most companies use 88% use straight line. Why? Because straight line is easy to do is the biggest reason for that. 4% use units of production, 7% use accelerated methods. And just another little example that you can work through. I'm going to click through it. You have access to these slides too through my accounting lab. And these are also in your book. If you are reading your book, you see these examples. And last, double declining balance. Again, the rate remains constant. Some other things we want to think about as we think about recording depreciation for plant assets. Plant assets are complex because they have long lives. Depreciation affects your income taxes. Gains or losses when the plant asset are sold. Depending on my book value, I may have a gain or I may have a loss. And international accounting changes in the future are coming. They thought they would be here by 2014. That did not happen, but they still are saying that IFRS is going to go into place, so we will have to be aware of new rules when that happens. So accelerated depreciation provides the fastest tax deductions, and tax deduction decrease tax payments. And of course, then our tax savings can be reinvested in the business. You can put the money back in your business instead of pay taxes with it. And this is just an illustration between straight line and accelerated for income tax purposes. Another thing that you can do with many assets for business purposes are to use Section 179, of where you can expense off a large amount of money each year. Another thing to think about are partial years. Unfortunately, every company doesn't buy their asset on January 1st of each year, and if they get ready to sell it, they don't necessarily sell it on December 31st. So if we have a part year asset, we need to pay attention to that. If we had full year depreciation for this 20 years of $21,000, partial depreciation, we would need to take it times the number of months, or 9 months out of 12 to get the depreciation for the year. Remember, I said that we can always change our mind after we've done our estimate. So if the asset is in use and managers change its useful life or its residual value on the basis of experience and new information, that is accounted for in the period of the change. You do not have to do a prior year adjustment for that. And this is called a change in an estimate. So when you have a change in an estimate, you can just change it from that day forward and not have to go backwards or go back and correct past financial statements. Because it's a change in an estimate. So here they're talking about they had purchased, this high school had purchased equipment for $510,000. They had originally estimated a useful life of 10 years with a residual value of $10,000. The depreciation has been recorded for 7 years, and in year 8 they decided that the estimated life should have been 15 years with a residual value of $5,000 at the end. So at that point in time, they want to know, what is the journal entry to record the prior year's depreciation? There's no entry required because it's a change in an estimate. That's what we just said, not for the prior year. But how do we calculate the depreciation expense for 2014? At the end of the 7 years, we have used $350,000 worth of depreciation. We had the 510 minus the 10,000, and it was originally for 10 years, $50,000 a year. This means our book value currently is $160,000. So our new residual is $5,000. That gives it our depreciable base of $155,000, and we're saying it's going to last us for a total of 15 years, so an additional 8 years. We divide the $155,000 by 8 to get our $19,375 per year for the remaining years. So if you fully depreciated an item, or you have depreciated the item down to its residual value, you just don't depreciate it any further. If you keep it, you just keep it, and it sits there on your books at that book value until you sell that item or dispose of it. Take a quick look at disposing of an item. If I want to dispose of an item, I'll make sure my depreciation is up to date. I will record any expense up to that date of sale, and I will remove that asset in any related account, therefore it's accumulated depreciation from the books. So this was jacking a piece of equipment that had a book value remaining of $10,000, therefore we had to book a loss. If my cash received is greater than the book value, then I have a gain when I'm selling. If the cash is less than the book value, I have a loss. So a few more examples here. We sold equipment on September 30th for $7,300 cash. The equipment cost $10,000 when purchased, and it's been depreciated straight line with 10-year life and no residual value. So basically $1,000 a year. Partial year depreciation must be recorded for the asset depreciation for the 9 months. So that's what the $750 is, 9 months of the $1,000. Okay. So we now have a book value of $10,000 minus $3,750. Or a book value of $6,250. We received cash of $7,300. Therefore, we have a gain because our cash received was more than the accumulated depreciation. book value. And if you notice here, we were getting the clearly we got the accumulated depreciation off the books. Right here. And we got the equipment off the books. We've got to zero those out. And just another example. This is a loss. I can also exchange one plant asset for another. So if I trade in my old asset and there's no money exchanged, it's one way. I can give up the asset and cash is paid, or the difference between the fair value of the old assets and its book value is gain or loss. So these are just a few little tidbits to pay attention to. So Papa John's trades in the old automobile for a new one with a fair market value of $15,000 and pays cash of $10,000. The old auto has a cost of $9,000 and accumulated depreciation of $8,000. The implied fair value of the old car is $5,000. $15,000 minus $10,000. The cost of the new delivery car is $15,000. Fair value of the old asset $5,000 plus cash paid of $15,000. They record the transaction as the new delivery vehicle is clearly $5,000. The cost of the new delivery vehicle is $15,000. The old accumulated depreciation was $8,000 given to us here. Okay. The old delivery auto had a cost of $9,000. We have to get that off the books. And we paid cash of $10,000. We had a gain then of $4,000. So with our natural resources, I want to just cover this pretty quickly here. That this is new, a new presentation way in this book. So if all of the extracted resources sold, the amount depleted has to be recorded. We record everything as an asset to start with, our oil reserve. As we use up the oil, or pull it out of the ground, we put our oil inventory, we move it into inventory. As we sell it, we charge it as cost of oil sold and reduce our oil inventory. So basically 3 steps. And intangibles have no physical form. You can't see, touch, feel it. Some have finite lives. If they have a finite life, amortization is recorded, straight line method, and an intangible asset reduced directly. If they have an indefinite life, we test it for loss and value impairment. We must make a judgment call on if it's still worth anything. And just a couple of examples for patents. And last topic we'll touch on are the effects of an asset impairments on the financial statement. Both tangible and intangible must be tested yearly. And it occurs when expected future cash flow is less than an asset's book value. The carrying value is adjusted to its fair value, and accounting for an asset impairment requires 2 steps. Once we determine the asset has been impaired, okay, we've determined there has been an asset impairment, so we therefore have an impairment loss, and we reduce the long-term asset by the same amount of the loss. And then just a couple of little ratios here to look at. We had the rate of return on assets, net income divided by our average total assets. Our net profit margin ratio, net income divided by net sales. Our total asset turnover, our net sales divided by average total assets. And then to get a return on assets, net profit margin ratio times our total asset turnover. And we haven't done a lot with cash flows yet. We're fast approaching the cash flow chapter. So it's nice to know which sections of the cash flow these affect. Depreciation is an operating expense, therefore it would affect the operating section. Long-lived assets are the investing section. If you are selling them, you have more cash, it's an inflow. And if you have purchased, you have less cash, it's an outflow. And that's the end of the chapter. Any questions that you can think of? Have you had a chance to look at your My Accounting Lab while I've been rambling on and seeing if you run into questions? Like I say, I'm sorry for all the yawning. Really jet lagged. All right, if that's okay. Is there a place that you can watch these sessions? Yes, you can watch them in YouTube after they have been uploaded by Central Office. So you don't know how to get to the YouTube links? No, that's interesting. All right. In the email that you received, do you still have that? Okay. I would think that in that email that you received, it would have told you a link to get to. It's going to be something in ivytech.edu. Let me see if I can find it. Oh, I don't know where the disconnect was about announcing these sessions. I kept saying that I didn't think anyone knew because no one was joining them except my students who I was telling individually. I have no way to contact students all across the state to let them know. And I know that I will tell you that some weeks my sessions are better than others. Some weeks I'm really struggling. Some weeks I'm more prepared than others. So anyway, there are YouTube videos. If I can find those links. Let me see if I have your guys's. Because another thing that is interesting is that when central office sends you guys out these emails, they don't include me on those. So I don't always know how these things are